Right now, the U.S. is imposing sanctions. It's a form of economic warfare, and it has a big implication for the dollar. Okay, now others are trying to get out of the dollar system. There's a dollar system that now is being changed. India is dealing directly with Russia, and holders of dollars and nominated assets don't want to hold those dollar assets if they feel that they're going to be grabbed and so on. So what's happening now has happened many times before. And I learned this in my past because in 1971 I was clerking on the floor of the New York Stock Exchange, and President Nixon gets on and he says, "We're not going to give you the gold that the dollar is backed by." And we had a devaluation. It took me by surprise. I walked on the floor of the stock exchange. I thought it was going to go down a lot. It went up a lot. And that's because I've never experienced the currency devaluation. I found the same exact thing when I studied history. Same exact announcement took place on March 5th, 1933 by Roosevelt, and had the same effect. So I understood then how history before me was important. Studying the Great Depression allowed me and Bridgewater to anticipate the 2008 financial crisis. If I didn't study that, what's happening now is very relevant. The past is a guide to what's happening now. As we are approaching a challenging of the world order, in other words, a great power challenging another, there is an increased likelihood of some kind of war. There are 5 kinds of wars. There's a trade war, a technology war, a geopolitical influence war, a capital war, which we're in the midst of, and then there's a military war. And those things drive countries to be self-sufficient and independent. And as a result, globalization diminishes and nationalism increases. It's not the stock market. In the book, it takes you through the stock markets during war periods. And so the only thing that matters for stocks is the cash flows. And as you get into the conflict, that's a different story. If you begin to see, as it progresses, those that are affected by the individual events have an effect, for example, tech stocks. But anyway, in answer to the question, how does it affect the markets? It affects the value of money most fundamentally. What we're seeing now is that the value of money, when you run very large deficits, you have to spend a lot. You have to spend a lot on social programs. You have to spend a lot on defense. You have to spend a lot on environmental programs and so on. And so when you spend a lot more money than you earn, then you have to print money to make up that difference, to make the purchases, and then that devalues money. And so it's like the examples I gave you of the 2 currency devaluations that you had before. 1971 led to the inflationary period of the 1970s. And so you have the stock market. Yes, the stock market goes up in other things, but cash is trash. And people then begin to learn that the bonds that they're holding have negative returns, and it starts to change the value of money, the value of dollars, and so on. So money goes into other assets. It produces more of an inflation, and you start to enter a certain type of environment. And the environment that we're in is beginning to be very much like that of the 1970s. There's 2 ways of dealing with debt. You pay it back in hard money, or you pay it back in soft money. You pay it back in hard money and you have a problem. You have a depression. So throughout history, whenever that was done, paid back in hard money, eventually that was abandoned and you print money. That was what 71 was. That was what March 1933 was. And so I think that what you have to think about is the value of money. How much money does one have in debt instruments? And do you want to own that as an asset? I think they're bad assets. And then how do you diversify? Do you find yourself with a substantial amount of cash that's currently idle and not generating returns? It's high time you explore the trading app I've recently started using, Moomoo. It now offers an impressive 1% APY plus an extra 3% API for your uninvested cash. You have to know that 1% API is 17 times the national average savings account interest rate, and there's no minimum deposit limit for cash sweeps. This is one of the highest interest rates I know of. Why I love Moomoo is it stands out by offering 0 commissions and no platform fees for stocks, options, and ETFs. It's packed with powerful market analysis features for absolutely free. For example, now is the U.S. stock market earnings season. Financial data, Analyst ratings, earnings calendar, and more are all free to use. The 6-8% margin rate is one of the lowest I've come across. You can tap into pro-level tools and information absolutely free. Sign up using my link below and grab up to 15 free stocks and park your EDL funds on Moomoo for a sweet 5. 1% APY plus 3% API extra, or earn up to $5,000 in cash rewards when you transfer assets to Moomoo. And the system also has to deal with what is money. Is the dollar going to remain the same sort of reserve currency? And then you see the development of alternative monies we're seeing. Variety, I think different types of money will compete with each other in the environment we're in. Maybe it's a crypto, maybe it's gold, maybe it's other things, maybe the digital or MMB competes with the US dollar. We're going to come into an environment. Think about how much money is being stored in debt. Instruments that was dead assets, think about how poor those returns are. So that kind of a shift in, I think, is very important. All currencies have a lot of debt. So when you look at one relative to the other, there will be a lot of print.